Of course, the other big sector mover this week, technology, falling from all-time highs. The sector underperforming the broader market, as we had mentioned. Amazon putting in its worst week since February. So what is next for this sector? Carter Worth is here to lay out the charts for us. Carter, what are you watching?
Sure, there's a couple things, but just I think it's worth noting we are sort of in the history books, if we will. We've gone 91 sessions without having 3 consecutive down days. Now, if you look back at the history of the entire sector, all sectors date back to 1989 when they changed the nomenclature. This has only happened one other time. Right? It happened in the July to December period of 2004. We went as many as 108 sessions without having 3 days in a row down. So we're at 91. This would be the second longest ever. And it's worth pointing out that in 04, after that happened, the sector dropped about 15% in a period where the market dropped 7%, so twice the rate of the market. Let's look at a few charts, one of 3. The first is what we know, how orderly this has been. This is essentially looking at the tech sector since the low. And you can see here, as I've annotated, we've had 6 distinct drawdowns, right? I mean, they're very clear there on your chart. And you can see that the duration, typically 3, 2 days, 3, 2, 1, 4, all very short term. And the drawdowns are between 8 and 5%, almost universally. So down 8, down 6, down 6, down 7, down 5. So you have these dips. And this is the part that's in the history book. They hold and they stick and they don't follow through. So the question is this, second chart. We are now right on the trend line that's been in effect since the low of March. Will this be like 04, where we actually eke out a bit more, or are we already on borrowed time? And the message from Amazon and the weakness in Adobe and some of these others is that this has reached its sort of end run. The final chart is a 2-panel chart, and just to put this in perspective, regardless of how good this is, and it's been darn good, what we do know is this, that the tech sector has still not recovered its losses to the S&P since its peak. So you're looking at now a 2-panel chart. That is the entire tech sector on top. And on the bottom is the tech sector's relative performance to the S&P 500. And you can see that, that on a relative basis, meaning the gains are still not as much as the gains of the S&P dating back to March of 2000.
Does this mean the entire index falters, Carter, or does this mean a change in leadership?
Well, remember, I mean, that has been the hoped for thing. There's always trades and cyclical things, but there is no enduring play in a value name. A value name imputed in the process, right, is that one sees an opportunity, a mispricing, whereas growth, something that's winning over time, is where your money wants to be. You don't want to find something that you can catch a trade unless you really have that kind of dexterity. Over time, you want to find businesses that are disruptors, that are taking market share on a long-term basis. So can Ford Motor beat Adobe on a 3-month basis, or Royal Caribbean because there's a virus? Sure. However, on a 3-year basis, betting on a Royal Caribbean versus a Microsoft, that's a ridiculous thing.
All right. Carter, thanks. We'll see you later on Options Action. Tim Seymour, that sounds pretty dire.
Well, once I figured out what nomenclature means, I definitely got excited about it. I think it's very difficult to see tech breaking this outperformance relative to growth. And again, that's on a PE basis, and that's on an absolute basis. I think we'll see value come back into the fold. A lot of these industrial names have some room to go. But giving up on the tech trade, I think people are just waiting for a pullback.